Federal Reserve, we did a whole sweep on this yesterday, right? We were talking about what it is the Federal Reserve does, why it matters, and we're going to talk a little bit more about that today. But this chart is the chart that matters most, okay? So remember, the Federal Reserve manages our economy in two profound ways, okay? The first thing, I'm trying to articulate this the right way. You all know that an election is coming up. You know that the Senate will be meeting. You know that whoever wins the Senate, if the Democrats hold the Senate and the House, they're going to be able to pass whatever legislation they typically want around the economy. We just had the Inflation Reduction Act. Sure, it's going to do that. We possibly are going to have student loan forgiveness. Some other things are on the docket. But right now, the key thing that we are paying the closest attention to is the Fed, which meets tomorrow. I don't care about the election. I don't care about who's in charge, because the only thing that really matters to me is what the Federal Reserve does, because the Federal Reserve has, as a trader, who I care about, because as we have seen, the Federal Reserve has driven this market over the last 13 and a half years. And if you go back further, you see that the Federal Reserve's actions on interest rates, the Fed funds rate is the name of it, the federal funds effective rate, if you really want to dig into it. Thanks, Fred, stlouisfed.org. The Fed raised rates in the late 1980s to try to cool down that market. Remember, we had a little bit of an overheating economy. That helped fuel that economic recession that we had in the early 1990s, the Gulf War. That recession cost George Herker Walker Bush the presidency. So the Fed has a more impactful impact, not just on the economy, but on the politics, whether it's direct or indirect. So you see 1990, they cut rates. We had lower rates in the early 90s. In 1994, we aggressively raised rates. We did not have a crisis here in the United States, but we did have one in Mexico. We effectively broke the peg between the Mexican peso and the U.S. dollar, created all sort of economic chaos with one of our largest trading partners. The IMF had to step in. The United States had to provide a little bit of a bailout. And every time that the Fed has moved aggressively on interest rates, a crisis has happened somewhere around the world, or it has happened here. Here is the late 1990s rise. Well, that coincided, obviously, with the dot-com bubble. Huge move down, markets trailing. 2006, you already know what happened in 2008. You had a market implosion of Royal Bank of Scotland back in 2007. You had all of the other mortgage companies imploding in 2007. Bear Stearns collapses, Lehman Brothers collapses, and now we have virtually no interest rates. The Fed trying to prevent a deflationary spiral, those huge amounts of capital that left massive holes in the economy from credit default, CDOs, and all of the other leveraged products. So what happened? Well, we tried to raise interest rates again back in 2018. And all of a sudden, we had the biggest downturn in global assets that we had since 1900. And again, you can see the trajectory down, this trend of interest rates over time. That actually matters. It is just like any other technical channel. You can see that eventually these things do seem to correct to the downside. Well, what is different this time? What is different this time is that the Federal Reserve must address inflation that is running out of control. Inflation currently is at 8.3%, the CPI. If you measure it with the cost of homes, you could measure it in around the 12.5% level. And if you're using the data that they used in 1980, which they changed in 1990, inflation would be somewhere around 15%. But let's just say it is at 8%. Let's entertain the Fed's number. The current Fed funds rate is 2.25. Tomorrow, it is likely to go to 3%. We will still be 5.3% behind the impact of the consumer price index. So our real negative interest rates in the United States are the Fed funds rate deducted from inflation, negative 5.3%. So the Fed has never in its history brought down inflation, particularly 2 consecutive prints of CPI over 5%, without bringing that number above the rate of inflation. The Fed is hoping that inflation will cool off over the next 3 to 4 months, that they will not need to go much more higher than maybe 4 to 4.25%. Maybe the number will come down. We may be in an environment, though, where inflation does level off at that 5% point, and they're going to have to raise rates. Again, they have not come out of this technical line all the way back to 1990. Well, that matters because inflation is the major difference here. There was no real inflation here for them to fight against. Now they have to break outside this bubble, and that's where the trouble starts. So yesterday, I was talking about the Fed itself. We walked through the different levels of what the Fed does, how it manages the economy, why it is important. And when I say it is important, I want to really stress this. If you think that President Biden and Congress have an impact on the United States economy, on a size level, let's say that size is the Earth. If you want to compare that to what the Federal Reserve does, the Federal Reserve is the sun. The Federal Reserve for the last 13 and a half years, coming off the back of that 2008 crisis, is effectively responsible for at least 93% of all returns in the stock market. And the Federal Reserve has effectively been 100% responsible for this market since 2020. And now that the markets are anticipating rate hikes, now that the market is anticipating that the Fed will reduce the balance sheet, which we talked about yesterday, now virtually every single thing that the Fed is doing is dictating this market. Yes, you're going to see some company beat earnings, and that's great. And you're going to see a move, maybe a 2 to 3 day move, and then you're not going to see a whole lot of just straight trajectory. The underlying motion of this economy and the disconnect between monetary policy and the current underlying economy, that is what is driving this market. So back in 2020 or back in 2021 in November, when everything was sky high, when the SPY was sitting way back here up at 480, this is the end of December. We were on our network and we were saying, guys, interest rates are at 0%. The cost of capital is 0. That is why Bitcoin can be worth $60,000. That is why Zoom can be worth $500. The moment that you start to increase interest rates, the cost of borrowing, this starts to impact the company's bottom line. It starts to impact its balance sheet. And if you start talking about an environment where a company was used to 0% for multiple years, in some cases 10 to 15 years, and now you're suddenly going to be at a 4% interest rate, and these companies don't make money, they're unprofitable, they're highly leveraged with debt. Now they have to roll over these very low bond price, these very low costs of capital to a 4% level. That is going to have a profound impact on their business. It's going to prevent them from expanding at the aggressive rate that they were. That matters because companies that were unprofitable traded at really high multiples, price to sales, price to revenue levels that were nosebleed, completely unjustified, completely irrational, but driven by the cheap money policies of the Fed over the last 4 years, but really all the way back to 2008. Now, I talked about the two major things that the Fed does when it is contracting monetary policy. And this is important, right? When you increase your interest rate, if I'm a small business and I am borrowing capital to expand my business, or I'm borrowing capital in order to put certain products, to finance certain products 45, 65, 90 days out, and now the cost of that interest rate goes higher, it's going to likely cause me to pull back my spending if I need to be more protective. That impacts businesses and it impacts consumers as well. Higher costs of borrowing will deter people from buying new homes. Higher cost of borrowing may impact what type of vehicle somebody might purchase. Higher cost of capital may impact their credit card decisions, whether or not they decide to keep a balance or not, whether or not they decide to consolidate cards. That can impact credit card companies. When interest rates go higher, I'm wearing a shirt that says Fund Through. This is a company that is based up in Toronto that I used to work for, and we focused on inventory capital management. So when companies' customers face higher interest rates, they end up paying paying me, right? Paying me as the business. If I am selling something to Bed Bath & Beyond and the cost of interest rate goes up at Bed Bath & Beyond is a bad business and they're struggling with their balance sheet, they may say to me, I'm not going to pay you for 45 days. Now, you know what? I'm going to pay in 60 days now. And they can get away with that. This is a notorious problem with a company like Amazon. Amazon doesn't pay its vendors for 45 days, and at the same time, Amazon competes against those vendors on their very platform, keeps their money and keeps it on their balance sheet. It is a very screwy story, and it should be illegal, but that's another story for another time. Well, small businesses are impacted much more aggressively than on the interest rate side than others. Now, on the open market operations, when they are expanding that, you're effectively selling, right? You're selling bonds back into the market. That creates less liquidity in the market. That's why you're seeing the bonds go a little bit crazy right now. That money that thrust into the market, the Fed had a $9 trillion balance sheet over a period of about 11 and a half years. That money that goes into the bond markets or goes into the mortgage markets, it always does try to find a way back into the equity markets or into other assets that really have no business getting that type of capital. But as interest rates rise, we see people look to the 10-year treasury bond and say, wow, 3.5%, haven't seen that in 10 years. Why am I trying to own a company like Meta, which is getting destroyed, when I can guarantee the risk-free rate of the 10-year bond? And that is the risk-free rate. That is what you compare every single potential investment to. If you are doing what is known as CAPM, you look to see, am I going to beat that 3.5%? And how much risk will I have to take in order to beat that 3.5%? What is my downside? And then this is all the measurements that go into long-term investing at any fund in the world. The other component of this, though, is the second thing. And I did not talk about this yesterday because it requires a little bit more of a quicker examination, and that is raising reserve requirements. Okay? Now, what does this mean? The banks, as I explained, are working are being effectively directed by the Fed on how they manage their capital. So let's say for a moment that you are a bank and you have $5 in the bank. You then can leverage that amount of money to lend it out to other people. So at any given time, on the $5 that's sitting in the bank, there may be $40 out there in existence, which is a leverage ratio of 8-1. There may be 100, which is a leverage ratio of 20-1. Back during the financial crisis and multiple crises that we have seen, that leverage that is at the banking level is typically a massive problem that we see when crises happen. Because when there is a lack of liquidity, it makes it very, very difficult for these companies to ensure that they're going to be able to get payment and also secure the reserves that they have. So back in 2008, at the time, this was a huge mistake by the SEC under Cox during the Bush administration. They raised the reserve requirements for the top 6 banks to about 30-1. So these banks have let's say you have $1,000 sitting in a vault, and you're lending out $30,000 on that leverage. Basically, I mean, that's the easiest way to describe it. The point of this is that in a contractionary environment, when they raise the requirements, when they effectively force them to have more capital and reduce those ratios, to call in more capital and ensure that they don't lend out as much and they don't expose themselves to this leverage, that reduces the velocity of money. That makes it harder for businesses to get loans. It makes it more competitive. That's why your credit score will matter when the financial crisis endures. If you were below 700 right now, it's going to be very, very difficult to get a mortgage loan, a new car loan. They are going to start to look up to the people who are in the very good category or above 800. That's the importance of credit, of credit, both here at the consumer level, but especially at the business level, if you mean to expand. Now, one of the other key things, what is happening in the chat? Why is everybody talking about, who cares right now about COVID and all this stuff? All right. The economy is cooling. All right. Sentiment on housing is slowing down. It's really slowing down. As you can see on the left, you look at traffic coming down. The present's kind of coming down. 6 months ahead is coming down. And then the oil and gas rig count is coming down. These are concerning numbers. And the reality is that it takes a little while to bring certain things back up online. So the fact that oil prices are pretty good right now is a good environment to be drilling for oil up at around $80 per barrel, right? 83 per barrel. No, they're mothballing. They're saying we're going to walk away. The United States needs oil for the Strategic Petroleum Reserve. They're not going to be doing it. They're going to walk away. They're shutting down some of these rigs. Meanwhile, housing, we had an interesting report today, right? So we saw a big uptick in housing starts, but permitting was down significantly. And remember, the permitting is where you really get this whole process underway. Building permits, big drop down, 10% drop. And that is a sign of contraction in this market. Construction is a very critical component of the employment market, but it's also extraordinarily important in the broader economic perspective. As I've said, we pay very close attention to housing because housing and other cyclical products are the primary drivers of GDP expansion and contraction in the United States. So yesterday, we learned that the Atlanta Fed had taken its GDP number of 0.5% for the third quarter. It was up at 1.5. They've now dropped it down to 0.5. I'm still taking the under. And we also saw Goldman Sachs say 0% for the third quarter. Goldman Sachs also has said 0% for 2022. That is officially stagflation. So what we're looking for is another negative print on GDP for the third quarter. And at that point, the concerns about inflation really turn to recession and stagflation. And I assure you, that is much, much worse. The market is going to be reacting to this. We're going to pay very close attention to what Chairman Powell has to say tomorrow. He is going to have to walk a very tight rope over the next 24 hours for us not to sell off aggressively on Thursday and Friday. And again, looking long, if you're going to be short in this market, it's very, very tricky. We have seen multiple times where the Fed will speak and the markets will rip. And the only reason that happens really comes back to this chart. This is tomorrow's meeting expectations. There is still a lot of money betting on a 100-point hike tomorrow. Once there is confirmation that they are going to 75 points, and once there is Powell speaks 235, we're looking for all of this to have to be unwound. And that can push the market much higher, much faster. Does it mean that it's going to be the start of a rally? No, because my expectation is this market will sell off on Thursday on the back the same way that it did back in June. This is the third consecutive 75 basis point hike. It is also the last time that we are up at 3% was 2008. And that was when the Fed was cutting rates. So they were coming down. They were coming to zero. We're going up. We're going up in the opposite direction. So you have to be very, very patient in this process. There are going to be moves in this market that aren't going to make a lot of sense. There's going to be a lot of chop. Pay very close attention to support levels. 3,900 has proven to be the support level for the S&P 500 right now. Downside target, if we break under that 3,800 level, the next move is down to about 3,640. That is the low of the year. I still anticipate a lot more pain will come, but understand there's going to be chop and lots of chop along the way. All right, that is why we are opening up for 1 month. We're doing the world's biggest trade, so we have a 1 month program. We're looking for the world's biggest short right now. Okay, so we're preparing ourselves. The Fed is reacting. We have our daily momentum indicator that we're following, and we are looking effectively for this Thursday to be the start of something very significant. Keep in mind, however, that the Fed is likely to raise rates again in November and likely again in December and possibly into February. Along the way, there will be a lot of chop. That is why we start to target specifically the third Friday of the month next October, the 21st. That is where we're really going to build our short positions to take aim at this market. I anticipate that we are going to get back to those June lows relatively soon. The bond market is having the exact same reaction to the Fed's actions now that it did back in November in 2018. And then in December of 2018, we saw a 19.5% drop in the S&P 500. I expect to see something in that territory, anywhere between 15 to 20% by either the end of October or mid-November. And then possibly a little bit of a relief rally on the back of that election. All right, let me take a couple of questions real quick before we jump over to WBT. How do we know when we're in stagflation? 0% growth and high inflation. I mean, some people will say low growth and high inflation. Some people will say we're in stagflation now because the real funds rate is minus 5%. But I've always been educated that the technical definition is 0% growth or negative growth and high inflation. And that is where you get into a recession with inflation, and that's the repeat of the 1970s. And it is not fun. Shorting the Russell makes sense. Every time the Russell's broken under support of the 190 in a negative momentum environment, it's gone to at least 170. How do you know if we're in a depression? You would have negative. You would have negative economic quarters of minus 10%. You're not going to get there. It would really be difficult for that to happen in this type of recessionary environment, inflationary environment. It's a very good question. I mean, there's a meme going around where Powell says, "Oh, well, it's inflation, it's transitory." Okay, well, it's entrenched, but the economy's not in a recession. Okay, yeah, we're in a recession, but you're not going to lose your house, and then at the end, it's like, okay, well, you're going to lose your house, but at least you're not going to starve to death. We're in the you're not going to lose your house type of territory, but it's getting pretty ugly. Should there be factoring of a coming election here between October? I don't really think this election matters much to the market. I really don't think it matters. There's nothing really significant on the docket right now that would translate into any level of economic activity. The central bank is forced into the situation where it has to address inflation by itself. Currently, Democratic control of Congress and the White House has allowed them to pass the Inflation Reduction Act, which was really just a big green stimulus deal and will not reduce inflation. And the reason it won't reduce inflation is because the money that they claim that they were saving on the deficit has already been spent on student loan forgiveness, which is also inflationary because you're just writing a blank check to people for $10,000. That's also not going to stop the inflation of education, which is going to continue, housing, which is going to continue, and food. You want a real sense of whether or not we're in a depression. I think the last time that food, healthcare, and housing all fell simultaneously in pricing, that was during a depression. That is important because those are things that matter. Those are the three things that the government subsidizes the most: food, education, housing, and healthcare. Those are the four big ones. So, and college prices are not coming down. The long shot today was what, Scott? We were doing. Give me 1 second. I'll pull it.
Hey, while you pull,
we'll throw it into the chat.
There's another question in chat from MAP. Do we keep our powder dry until the Fed meeting, or are you going to make a play before the Fed meeting over in the world's biggest trade?
I'm going to wait. I'm primarily waiting until the Fed meeting, and the reason is pretty simple, because we've seen every single time at that 235 level, whatever direction the market moves at 235, 5 minutes into Powell speaking, that has been the direction of the market for the rest of the day. So I am more content just to wait. You're going to see some choppiness. You may see right around the 2:30 hour. The only thing that I may do is take a very small short-term call into tomorrow, and the reason is that we may see that FOMC drift. We've seen the market sell off this morning, and it's trying to move back. I had a spread in place. It stopped out. I may take another very small bet on that, but I'd be much more content to really bet directionally after this. And then on Thursday, that's where I'm looking for this market really to start its volatility cycle up again, now that we actually have a clear path on the 75 basis points.